Okay, welcome to 22-4 Work Together, which is doing our closing and reversing entries for our corporation. So we are at the very end of our fiscal period and we need to make sure that our accounts are up to date and ready to go for the next fiscal period. So you can see that we have two steps here, doing our closing entries and then also doing our reversing entries. So two steps in this problem. We have our adjusted trial balance and our chart of accounts listed here in case we need that. And as we scroll down, it says we're going to use the information in our question assets to journalize the closing entries for the current year for our Travel Light Corporation on page 13 of our general journal. So I'm going to adjust this and get this out of the way. And I'm going to come down here. Remember that with closing entries, they're the same as our adjusting entries. So there are no document numbers. Instead, our heading closing entries serves as our document number, just as it did with our adjusting entries here. Notice that we have no document number listed here. So if you remember, our first closing entry is to close all of our income statement accounts that have credit balances. So if we scroll down on our adjusted trial balance and we start with our first income statement account, that would be sales that has a credit balance. So in order to close sales, we need to debit it. So what we're going to do here is I'm going to put the date in as December 31. And then we are going to start putting in all of our accounts that are going to be debited. So our first one is going to be sales, and that's going to be debited for the full $587,934 and 15 cents. And then our next one is purchases, purchases discount. Our purchases discount is $27.41 and 80 cents. Our next income statement account that has a credit balance is purchase returns and allowances. That has a balance of $13.58 and 7 cents. The next one, in order to find it, we're going to have to scroll for a while because it's at the very bottom. It's our interest income. So we plug in interest income here. That's going to get debited for $584 and 74 cents. And then rent income for $1,000. And our last income statement account with a credit balance is gain on planned assets for $55. So remember that when we're closing entries, what we're doing is we are debiting all of these to close, and then we'll be putting it into our income summary account. So our credit is going to go to income summary for the total of all of these amounts. So we're going to total all of these, and when we do that, we end up with a balance of $593,673 and 76 cents. So we plug all of those in here, and then we are ready to do our next closing entry. Okay, our second closing entry is going to be all of our income statement accounts that have debit balances. So if we have these accounts that already have debit balances, to close them, we're going to need to credit them. So what we do here is we're going to put December 31st. And then remember that since all of these are going to be credited, what's going to end up being debited is our income summary. So I'm going to put income summary in here now to start, but we're not going to be able to know that amount until we total all of our income statement accounts that we're crediting. So to start off with, our first one here is our sales discount. So we're going to plug sales discount in and $1,010.40. Then we have sales returns and allowances, $4,173.60. Our big one is purchases, which has, oops, and look at me. Sorry guys, these all need to be credited. Silly me. I hope someone caught that as we're going through all of this. Silly me. Because they have debit balances, we need to credit them. So we'll fix this here. Luckily, it wasn't too far into all of our list of ones. So as we scroll down, then we start with all of our expenses. So we have advertising expense, 7,973.50, and cash short and cash short and over, 458. Credit card fee expense, 5033.47. And I'm just gonna scroll up a little bit. We have depreciation expense, equipment for $22.50. Insurance expense. Now the big thing is you're going through this to make sure that you're going. I mean, I know it's a lot. I know that they're long. Just think though that there are companies that have 10 times as many accounts as we're dealing with right now. So just making sure that you're going slow enough that you recognize and don't miss any of these expenses. We wouldn't want that to happen, or to be putting the wrong number with each one. So just make sure you're going slow enough to recognize those. So we're on repairs expense, 1,742.50, and salary expense, 79,482, and supplies expense for 150.04, uncollectible 3675. Oops, went too far. Okay. We've got a few more here. We've got utilities expense for 30.50, and then federal income tax expense for 14,171.44, and then make sure you scroll all the way to the bottom because we do have interest expense and then our loss on our plan asset that we need to close as well. So 1370.65 and our loss on plan assets of 124. So that's the worst one because we have all of those expenses plus the few other ones that we have, other accounts that have debit balance that we need to close. So when we do this and we total all of those up, we come back up here to our income summary amount that gets the debit, and that total is $544,505 and 68 cents. So remember, our first closing entry is all of our income statement accounts with credit balances. Our second one is all of our income statement accounts with debit balances. And now we're ready to scroll down and do our third closing entry, which is recording net income or net loss. Okay, so our third income statement, our third closing entry is to account for net income. Or a net loss if we were to have that. So let's plug in our December 31st, and then we need to figure out whether we had a net income or not. Now, if you do remember from our last few work-togethers, we did have a net income we had found, but Appley is being kind of tricky. They didn't flat out give it to us, so we have to figure it out. So remember that we figure out our net income by figuring out what the balance in our income summary account is. Now, if we were to only look at these two balances here, our income statement credit amount and our income statement debit amount from the two closing entries, we would be wrong. Because if you remember, income summary already has a credit balance of $12,900 from our merchandising inventory adjustment. So we take this $12,900 as our credit, and we add to it our income statement credit amount of $593,673.76. We add those two together, and then we subtract out our debit amount. And when we do that, we get an amount of $62,068.08, which is a net income. So when we have net income, right now, income summary has a credit balance of that because this number, the credit side, is greater than the debit side. So when we do that, if it has a credit, we're going to need to debit income summary to close it. So income summary is going to be debited. And then if you remember, retained earnings is that account where we hang on to all of our extra money that we have, any profit that we have, we hang on to it. So again, our amount is $62,068.08. Now, if it's hard for you to remember, if income summary has a credit balance, that means we have a net income. And if income summary has a debit balance, that means we have a net loss. If that's hard for you to remember, I usually just try to think like, do we have a net income? And if we do, that means that retained earnings has to go up. It gets credited. Retained earnings is an owner's equity account that increases with a credit. So I just think if we have a net income, retained earnings has to be credited, which means income summary has to be debited. And if it were to be a point where we have a net loss, that means that we actually have to take money out of this retained earnings account to pay for our loss. So that's the way I think of it. If that doesn't work for you, you can think of it the other way, but that's what I like to do. And then our last closing entry, number 4, is to account for dividends. So dividends has to close. It has a debit balance, which means that we're going to have to close it. And remember, where do dividends come out of? They come out of retained earnings. So similar to that net income I was just talking about, retained earnings actually gets debited. So the amount of money the corporation hangs on to goes down because they are paying those dividends out. So dividends gets credited for the amount that's listed in our, 21,600 in our adjusted trial balance right here. So those are our 4 closing entries. Income statement accounts with debit balances, income statement accounts with credit balances, income statement accounts with debit balances, net income or net loss is number 3, and then our 4th one is dividends. So our next step is we're going to do our reversing entries. I'm going to do that in a separate video here because we're almost out of time. So I will meet you over there for part 2.